Well, it certainly is a bit of a problem for the Fed, but the Fed can rationalize an easing of financial conditions by saying that so much of the impact to the economy from the rate hikes it's done thus far hasn't really turned up in the economic data yet. So there doesn't need to be as much of a focus on financial conditions. And really, they've admitted as much in the FOMC minutes and in a number of different places when Jay Powell has been interviewed. So to me, I think the Fed needs to look at the totality of circumstances, and it is clearly worried about what it is doing to the economy by hitting it with a giant mallet. And I think it becomes more data dependent now, very, very sensitive to incoming data, and also anticipating there's an impact that hasn't been shown yet that's rather negative.
Oh, I'm sorry, Caroline. Where do you see the resiliency then of these equity markets as we continue to climb back up to 4,300 on the S&P?
Well, let's face it. I mean, the equity investor is more of an eternal optimist, and the fixed income investor is more of an eternal pessimist.
Caroline hates those.
and so where we are today is at a crossroads, right? And I think that if you interviewed 100 people about whether or not the economy is going into recession or is in a recession, you get about a 50-50 split. And that's really why we're seeing different signals in the fixed income market than we are seeing in the equity market. But I do believe that I would give a slight increased probability to equities and optimism, in that I do think the Fed is going to be able to navigate a softish landing. I will not go out and say soft landing, but I will say a softish landing. And that is, to me, why we're seeing stocks do what they're doing. This expectation that the Fed isn't going to be as aggressive as people think. And I'll just point to one thing. So if we look at the median year-end dot plot, the Fed funds forecast, 3.4%. But what we heard from Mary Daly was that we're probably going to end the year at a smidge over 3. And, well, some might say she's more on the dovish end. I would argue that we'll probably end below 3.4. And so that is, to me, good enough. It's enough encouragement to sustain stocks.
Okay, all stocks, because we are starting to see initially value has had a great run. Energy has been outperforming. But as we start to, who knows, unclog a little bit in terms of supply chain, start to ease up on some of our production versus supply side, will we see a rollover of that? Will you see more growth outperform as we slow?
I do think we're going to see more growth outperform, but it's going to be very selective. And a lot of it is going to be around those companies, those industries that are able to defend margins, pass on costs to customers, all those things. So I think it's going to be a different environment that's much more selective as opposed to a rising tide floating all boats.
Well, Christina, thinking about growth versus value, I want to talk a little bit about valuations, because I was looking at the Nasdaq 100's 12-month PE ratio, for example, and with this big rebound we've seen, it's actually above its 10-year average. And I'm curious, when you think about stats such as that, how expensive do stocks look right now, some of those high growth areas of the markets that have started to perform again?
Well, you might hate this answer, Katie, but it's all relative.
Okay.
But yes, some stocks are looking relatively expensive right now. The reality is that we are going to see some downward revisions to earnings. And so again, I think there are going to be winners and losers in this environment. Some are going to seem a lot more expensive than others once we get through that earnings downgrade portion of the next few months.
Continue to go cross-asset with us. I like that you talked about equities being more the optimist, bonds being more the pessimist. And yet, I am curious what you make of high-yield spreads over treasuries that did not blow out, the lack of spread widening, the lack of worry, and if that also then sort of confirmed the views of maybe this more soft-ish landing, then the bond market, at least within high yield, wasn't as worried.
Well, You could argue that high yield is most like equities, and so you can make the argument, and I think there's a lot of validity to it, that there isn't as much concern. I also think it has a lot to do with the fundamentals right now in high yield, where we don't have any kind of significant cliff coming up anytime soon. Many companies took advantage of refinancing. They did that in investment grade debt as well as high yield debt, and that means that there's just a longer runway before we go through any kind of significant, essentially refinancing.
What do you make of the meme trade, and what do you make of whether people are asking about other alternative assets? Have any conversations about Bitcoin come up of late?
There are, you'd be surprised, but there often, I want to say there isn't a week that doesn't go by that I don't get questions on cryptos. But right now, I've gotten certainly less of those and more around meme stocks. But I think this is very much a symptom of the kind of environment we've been in for some time. There are excesses. I won't say bubbles, but there are excesses when you have a lot of liquidity. And so we do see things like cryptocurrencies becoming extremely popular, or meme stocks. It is also part and parcel of having different kinds of investors in the market. And so I think we're all kind of getting our arms around the concept of these investors that are living on Reddit and investing in meme stocks. It's just, it's part of reality now and is likely to continue to be.
Christina, great to have you here. The reality of her in the studio, Christina Hooper, Chief Global Market Strategist for Invesco. We are currently moving closer to the closing bells. Full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And we are but 2 minutes away from the end of the trading day. Caroline Hyde, Taylor Riggs, Katie Greifeld, counting you down to the closing bell. Here to take us beyond that bell with a global simulcast. Carol Massa.
Negative territory. It's been that kind of day, Tim, where we're just up and down an awful lot.
All right, I'm going to take a step back here and reference some comments that Alan Zafran, the founding partner and co-CEO at IEQ Capital, who we just had on our air, mentioned to us. She said the stock market with this rally is essentially telling us there either won't be a recession or the recession will be so shallow that you won't see an earnings recession. And he said that the likelihood of the Fed actually getting it right, i.e. threading the needle, he thinks it's much more likely now than it was a month ago. He thinks they could get it right.
Dare I say it, we just had Christina Hooper here of Invesco also hinting at sort of a soft-ish landing, and Katie really talking about maybe the lack of spread widening, that the high yield market is also sort of further signaling that corporate balance sheets are strong. There's sort of a real cliff that we're approaching anytime soon on the horizon. Borrowing costs have been locked in, and so at least from that sort of cash flow perspective, things too also look good.
Interesting to couch that against what we're actually hearing from Fed officials. I'm thinking about Kashkari just today saying it's unclear if the Fed is going to be able to get a grip on inflation without tipping us into a recession. So a lot of optimism on the market, not so much among Fed officials.
They're really trying to talk. Well, keep out there, keep telling us there's more wood to chop, there's still more places to go. We need to stick on this narrative that inflation is our focus. For now, our focus is the SP 500 ending the day up 10 points, up 0.25%. We managed to get that lift just into the final seconds of trade, and 4,284 is where we closed. The Nasdaq closing up 0.2%, 12,965. That's 27 points higher. And Carol, we managed it with the Dow. We just scraped into the green, up just 20 points, but a round number of 34,000 on the nose. Russell 2000 is also higher, but a smidge. But overall, this is a market that really clawed its way back up.
Yeah, certainly on those major broader equity averages. shortages. I'm going to sound like a little bit like a broken record because I'm going to go back to the semiconductor names because that's where you continue to see some outperformance really all day today. The stock's ending up about 2.3%, Taylor.
You see some outperformance in terms of the individual sector levels. There's a little bit of green even in some of the, quote, worst performers. So a little bit of an advance here when you think about the majority of sectors here that actually were in the green. You get energy, of course, continuing to be a big outperformer, up 2.5%. Some of the semiconductor equipment, also Qualcomm, certainly, Carol, one that you've been talking a lot about today, up 2% or so on the day. Down to the bottom, things are looking a little bit less interesting. We've talked a lot about banks and real estate as sort of the big sort of yield drivers that are under pressure today. Pharma, telecoms as well. The worst performer, though, still off less than 1%.
All right, so let's get to some of the individual gainers in today's session that was kind of all over the place. Certainly a standout. You know, I've talked a lot about semiconductors. Taylor was mentioning as well on semiconductor, top in the SP 500 today, hitting another record high, up about 7.3% by the closing bell. Remember, earlier in this week, the company reported second quarter net sales that beat the average analyst estimates, upped again its outlook for net sales and adjusted EBITDA for full year 2022. It is up around 10% so far this year. Cisco, we were all over it yesterday after the closing bell when it reported its quarterly update. It, too, was top of the S&P 500, Nasdaq 100. It had a bullish forecast for quarterly sales, saying chip supply shortages are easing and it is able to fill more orders. So that stock up just shy of 6% in today's trade. And then I'm going to go to the retail sector. This has been a big, major theme all week. BJ's Wholesale Club, this stock up 12% at its highs today, finishing the day with about a 7.2% gain. This, as analysts tout the Warehouse Club operators' adjusted EPS as stronger than anticipated. They kind of did brush off the company's margin pressure, but that was kind of expected, they said. They also did raise the company, that is, their fiscal year 2022 guidance, and they do say, Tim, that their expansion plans remain on track. The stock hitting a record high today.
All right, you got the gainers, I got the decliners, Carol. We got to start with Kohl's. Kohl's shares finishing the day down by 7.7%. The company slashing its guidance for the year, including adjusted EPS, operating margin, and net sales growth. Bed Bath & Beyond having its worst day since June, finishing the day down by 19.6%. This after RC Ventures, Ryan Cohen's firm, said in a filing that he may sell as many as 7.8 million shares along with some call options. You remember he took that stake back in March, nearly 10% stake in Bed Bath & Beyond. And then Verizon shares finished the day down by 2.5%. This after MoffettNathanson cut the recommendation on Verizon Communications to underperform from market perform. This as T-Mobile continues to widen its competitive advantage when it comes to 5G. And then you have AT&T undercutting Verizon with aggressive promotions. Craig Moffett lowering that price target to $41 from $55 per share.
There's names have been beaten up of late when we start to think about a consumer that pulls back. We've got so many earnings to get through in a moment, so I will make this brief. Commodities go higher with oil, with WTI, with Brent. We push on higher as there's more bullish sentiment in the oil market at the moment. Even as on the FX side of things, guys, we see a dollar strength, 0.6% higher on the Bloomberg Dollar Index. We see a weakening in the British pound, a weakening in the euro, a weakening across Europe, across the other key G10 currencies. More hawkish Federal Reserve comments. Maybe that helps the dollar go higher. And in sovereign bonds, really mixed picture. It looks as though it was money coming out of bonds today, certainly in Asia and Japan and New Zealand, Taylor.
You see yields, of course, here, Caroline, a similar story. Yields are down here, particularly on the 2 end. You're down 8 basis points or so on the day. Price higher, yield lower. It gets less dramatic the further you go out on the curve, anywhere from about 2 to 3 basis points or so. A lot of the movement, again, in the front end. I want to pivot and talk about a lot of the movement within the equity markets again. We're getting reports again from Ross Stores. Second quarter actually looks okay. The comp sales were down 7%. Estimates were for a decline of 6%. But the second quarter operating margin was better than expected at 11.3%. And second quarter EPS was also better than expected, $1.11 versus estimates of $1.01. Unfortunately, though, it's that forward guidance that doesn't set us up well. Third quarter earnings per share looking at 72 to 83 cents. Previous estimates had been for over $1. And again, then that full year EPS, big decline here relative to consensus, as low as $3 384, whereas the previous estimate, the Midtown range, had been about a 436. It's further these inflationary pressures, Katie, that are underway.
Absolutely. We heard that from the CEO, who said, we're disappointed with our sales results, impacted by mounting inflationary pressures. And of course, it's that outlook, as you can see, weighing on shares right now. It does not matter that maybe they skirted past in the past quarter.
Let's get on to the chips world. Manufacturing, marketing, servicing of semiconductor wafer fabrication. I'm talking about One Applied Materials. We are looking at a set of numbers coming out that see third quarter adjusted earnings per share beat estimates overall. If you're looking at what have been sales coming in at $6.5 billion. And overall, this is a company that actually sounds longer term confident. They say there is long-term strength in the semiconductor market and our outsized growth opportunities. However, the CEO is saying they delivered, despite record quarterly revenue, they still have supply chain challenges constraining their ability to meet demand. As I say, adjusted earnings per share beating, they're coming at $1.94, and that was well ahead, but only slightly ahead of last year, but well ahead of estimates. We see net sales climbing 5% year on year to $6.5 billion, Carol.
Yeah, AMAT, so up almost 2% in the aftermarket. It was higher in the regular trade. I mean, why do we care? I mean, we've been watching the semiconductor industry, and, you know, we just talked to our Ian King talking about kind of the ebbs and flows of this industry, and you tend to see, you know, lower supply, then a lot of investment, then the supply goes up and you have a glut. So this is why you have kind of a roller coaster in terms of some of the cycles. But why do we care? This tells us about kind of demand overall. I mean, this is a company whose customers include Taiwan Semis, Samsung Electronics, Intel, Micron. I mean, this is a very key name when it comes to the semi industry overall.
But we are not yet seeing a glut, and that's still a concern because of inflationary pressure. I mean, if you think about how many Americans are unable to buy vehicles and the way that the price of vehicles has gone up, partly due to the fact that they are so hard to get as a result of chip shortages. So as Ian King told us earlier today, when I asked him if it means we're going to start to see more cars on lots, he said that remains to be seen. I mean, look what we saw from Cisco yesterday, for example. Demand is strong.
And demand is strong. It's an interesting up the guard from a governance perspective. I always think it's important to think about governance because it is part of the ESG that we overlook in large part. A lot of that comes down to the role of the boards. Home Depot, of course, came out and beat expectations earlier this week. They've had a changing of the guard a little bit in terms of some executive roles, but they're also naming that they will have a new overall chairman of the board. This is seeing that Edward Ted Decker as chair of the board. He's currently on the board of directors. He's been elected CEO, president, and as chair of the board effective October the 1st. He will succeed Craig Menier, who is, of course, retiring as the chief executive September 30th.
Another